Well, welcome to the Front Street Foundation Money Series. I'm going to give you a little background about what the Money Series is, how it came to be, and what it represents. To begin with, this is a nonprofit program. So Front Street Foundation is a 501c3, and its main program is the Money Series, which is about open access to financial education for all. And which means that none of what you will see on a Money Series will ever have a commercial tinge to it. In fact, every speaker, I discourage any type of commercial messaging. But I am bringing up experts in their field, and I think that it's a nice, comfortable way for the public to learn about financial topics without fear of being sold. So that's really what the Money Series represents. I will say that in order to expand the education that the Money Series offers, we record all of these programs live. And I'll get into it a little bit later, but Traverse Area District Library has invested in wonderful technology here in the McGuire Room on the Woodmere branch. And it allows for us to have high-definition video, record it live, and then rebroadcast it for everyone to see on Channel 189, which is another cooperative partner, is Up North TV. We also do programs at the Senior Center. The Senior Center, we do a little bit of a different format. But there we actually record podcasts. So everything is audio recorded, and it's done in a more workshop setting at the Senior Center. The commonality here is that the library and the Senior Center are all information service providers for the public. And we wanted to create programming that was safe and that was informative for the public. So I always encourage people to go to the frontstreetfoundation.org website and look at the programming that's scheduled. And really, going over to the Senior Center and seeing what they have to offer with vast amounts of programming is something that I always encourage. I didn't introduce myself. I'm Jason Tank, and I am the founder of the Front Street Foundation. The website here, frontstreetfoundation.org, I'm showing you some pictures of past programs. All the programs, the entire archive of programs, is always available on frontstreetfoundation.org. It allows you to do what I think would be, to be able to share it with your friends, people who were unable to attend, to be able to really expand the knowledge of the public. So going to frontstreetfoundation.org, you'll see articles that are written. I write a couple times a month for the Record Eagle. As an investment advisor, of course, I have an expertise in that area, and being able to have that in the paper really only allowed me to have 500 words to say something. To be able to speak on these subjects, like our speaker here today, and expand upon something that takes 4 minutes to read, instead get an hour's worth of content, was really what drove the origination of the Money Series. So frontstreetfoundation.org is a wonderful spot to visit and to learn a lot more about financial topics. But before I turn it over to the speaker today, I want to highlight something about TADL, Traverse Area District Library. I don't know if many of you are aware, or if viewers are aware after they watch this recording, that there is actually a nonprofit wing within TADL called Friends of the Traverse Area District Library. It's really run by community members, volunteers. These volunteers are, put their time and effort to be able to provide extra services for TADL, such as the newsletter that goes out. In case any of you noticed, this program was promoted through a newsletter. They help fund the software service that drives that. Ancestry.com is another function that they provide money for, to allow you to be able to come in and use those services. And Poets Night Out is something that they have been supporting year after year after year. Friends of the Traverse Area District Library accepts donations, and I'm going to pitch them a little bit so that you can go on to www.tadl.org/friends and make a donation. And to incentivize you, I am going to donate a match up to $200 of collective donations received, as long as you write Money Series somewhere on your donation form. We have forms in the back and online. If you just put a little note that says Money Series, I'll match it up to $200 total. Of course, not $200 for every single person. But it is a wonderful thing to do to really allow for as much information flow as possible to the public. And I think Friends of of tattle is a way for you to support the local library. So with that, I've said enough. I want to introduce tonight's speaker. He's going to be talking about commercial real estate investments. And I'll tell you, I've known Dan Stiebel for a long time, actually, on multiple levels, both as a friend and as a professional. I think of Dan as a thinking man's real estate expert, very analytical guy, I tend to like analytical people, so I immediately gravitate to Dan whenever I'm talking about real estate, especially commercial real estate, which is his expertise. So I'm very happy that he said yes to me when I asked him to be a speaker. It takes quite a lot of preparation to put together a nice program for an hour, and I'm very, very appreciative of his effort. And so with that, I'm going to hand over the clicker to Dan Stiebel with Coldwell Banker Schmidt. And I'm looking forward to learning a lot today. Thanks a lot.
Thanks, Jason.
And your mic's on, right?
I think it's on. Can
Okay.
you hear me? Everybody hear me okay? All right. So I'm Dan Stiebel with Coldwell Banker Schmidt. I'm a commercial real estate agent. I've done residential real estate in the past, and tonight I'm going to talk to you about real estate investing, which I'll tend to focus a little bit on commercial because that's what I'm passionate about and know about. But really, it applies to residential also. So I'll talk a little bit about, if you buy a single-family home and rent that out as an investment, that would pertain also. Let's see if I'm going the right way here. Okay. So I wanted to start by saying, there's a lot of different ways people can invest money and invest their money. And Jason does financial management. A lot of financial managers focus on the stock market, bonds, cash. That tends to be the traditional way people look for a balanced portfolio between those. And those are great to have in your portfolio, but a lot of times real estate gets overlooked or is not part of that. And I've known a lot of people who have done very well investing in real estate, and it's a good tool to create wealth and something certainly worth looking at as whether or not it fits into your financial portfolio. I think for some people, they might hear what I say tonight and say, yes, definitely, and others will say, I'm really glad I listened to all that. It's not for me. So it is a little bit different from other investments in that it tends to be a little bit more hands-on, a little bit more work. But like any investment, you have to do your due diligence and look into it and decide whether it's something you want to invest in. And it is a great tool for wealth accumulation. So I want to tell you a little bit about me and my background. I'm a salesperson at Coldwell Banker Schmidt and do just commercial sales, which includes retail, industrial buildings, office buildings, vacant land for development purposes. I do leasing as well as sales, so a little bit of everything that's related to commercial. I started there 15 years ago, and after about 5 or 6 years, I wanted to do commercial. I did residential and commercial, and I talked to kind of the premier commercial agent at the time who said, if you want to do commercial, get your CCIM designation. It's a certified commercial investment member is what it stands for, and it's kind of like a graduate level training for commercial real estate. And I took the first class, which really I'll go into some of the topics that we learned in that class here tonight. But it was really analytical in a way of kind of evaluating real estate based on real metrics and not just I think I can make this or I think I can make that. But it was a great education. I took a class a year. They're week-long classes. You can actually, if somebody wants to take one, they're headquartered in Chicago. You can go out there and just take a class. Anybody can take one. There's 4 classes total. I thought the first one was on really investment real estate and was the best of the classes. But you also have to put together a portfolio of 30 sales and transactions if you want to get your designation of CCIM. And that took me about 4 or 5 years to put together. So I must have started the first classes earlier than I said. So I got my designation about 7 or 8 years ago, and since then I've just done commercial real estate and really enjoyed that. And then I'm also a investor, own some office buildings and commercial properties myself that I lease out. I'm a landlord, so I can really talk tonight from experience, kind of having gone through the process myself. My daughter helped me put together my PowerPoint presentation, so I want to thank her and point out that I actually said to her when she was doing it, I was like, I'm going to tell everybody that that's how you look at me, as kind of the big guy, you know, their hand on the building, and with the real estate. Good hair. Well, what she said to me is, she goes, Dad, you picked that graphic. The first one I had was the bald guy. So I wanted to tell you a little bit about how I got my start in real estate. And when I moved to Traverse City in the mid-90s, I had a retail business downtown, and it was a children's clothing store. And after we opened and had it for about 2 years, we were doing well in the business, but not well enough that I felt like, okay, I'm going to have a good retirement when I come out of this. So I decided the best way to really have a retirement income would be if I was paying a mortgage on a building instead of rent. And back then, buildings downtown were a lot less expensive than they are now, but interest rates were a lot higher. So I'd say my mortgage payment was going to be about the same as my rent, which is probably still the case because interest rates are about half now of what they were back then, even though prices are probably at least double. So I spent 2 years kind of knocking on doors trying to find a building downtown. I wanted to be on Front Street, and nobody wants to sell. And I finally found a building and purchased a building downtown. Plan was to move the store into the building and start paying off the mortgage. So I'd have this asset at the end of 20 or 30 years when it was paid off, and I could retire and sell the building and have some retirement to count on. And what happened is there was a tenant in the building when I purchased the building, and they were paying rent. And I think my rent at the time was about $1,800, and my mortgage payment was about $2,000. And I figured for $200 more a month, that's a good retirement. It's worth moving. But it turns out the tenant was paying $2,400 a month, and they paid all the expenses on the building too. So I was making $400 on the building without doing anything. Was going to need to renovate the building and do a lot to it to move my store into it. So I decided, after a couple of years before the tenant's lease came off, I had another tenant in there. I decided I'd be better off keeping that building, have the tenant continue to pay my mortgage payment for me, and stay in the building that I had already renovated where rent was cheaper. So about another year or two after that, I think it was around 2001, the building was making more money than I was in the business with a lot less work. So I said, I want to do more of this. But I spent 2 years trying to find this building. How do I find properties? What do I do? Probably some of you tonight are kind of thinking the same thing. All right, I'm interested. How do I find a property? What do I do? So coming to a seminar like this is a great first step. I decided that I would get my real estate license and sell real estate to kind of get to know Traverse City and get to know the market and what's out there. And that's kind of led to where I am today. So there's a number of different reasons that somebody might buy real estate. The two that I'm going to focus on tonight would be for your business. If you have a business, you might buy an investment property and then lease that property out to your own business. So you can be your own tenant, and that can be a good way to pay down your mortgage and save money, accumulate wealth. Or it could just be as an income property. So I'm not planning to live there. Maybe I'll get a duplex or a quadplex and rent it out, and I'll take that income. I'll be a landlord. I'll do some work for that. Or maybe I won't do work. Maybe I'll hire a management company and I won't have to manage the day-to-day of it. I'll get a little bit less income, but it'll be just more of a hands-off investment. And I will warn that if you do that, you still are responsible for picking a good management company and making sure that they're taking care of a property the way you would want to take care of the property. So you still have work. There's never getting away from all work if you're buying an individual asset and gonna own it. One of the biggest advantages to investing in real estate compared to stocks or bonds is that you can leverage that purchase. So you can borrow money and use debt and and essentially buy something that's more expensive than you would otherwise be able to. So it's a great tool for investing if you invest in the right things. There's good debt, such as purchasing a building, student debt if you're investing in your future and your education. Then you probably are going to make more money, and that can be good debt that you can pay off. Bad debt might be credit card debt, something, even a car loan if your car depreciates in value faster than you pay off your car. So I guess I always caution people, on debt. It's great. You can make a lot of money by borrowing, but you also risk more than you would if you weren't borrowing, and that's kind of what this slide illustrates here. So if you purchase a building for $100,000 and you've got, generally speaking, the bank will loan 80% of the value of the property, and that can vary a lot depending on residential homes. It might be 97 to 100%. On commercial, if your own business is in it, you might be able to borrow 90%. If it's a real risky asset, maybe they'll only loan 50%. So it changes, but 80% is a good rule of thumb. And in this example, if you were to buy a building for $100,000, take $20,000 of your own money, the bank lends you $80,000, and a few years down the road, the building's worth 20% more. So it only has to go up to $120,000, but you've doubled your money. Your equity in that building has gone from $20,000 to $40,000. Because you didn't, because the $80,000 loan is still the loan. This is assuming you've only paid interest on it and haven't paid it off. But the caution, the downside, is the building only has to go down 20% in value to wipe out your complete investment in that property. So there's definitely risks associated with it, but I think over the long term, real estate tends to appreciate. I think if you look at holding it for a long-term investment, that even after a down market, like we've seen recently, it will come back eventually. Nobody can really tell you when it's going to go down or when it's going to come back. There's a lot of conjecture and trends, but it's a long-term investment, and it is a illiquid asset, so it's not always easy to sell. If you need the money right away, you might keep your money in cash. I mean, if somebody was going to buy something for a year or two, I would say with the transaction costs involved in real estate, such as sales commission and tax and title insurance, you're going to need to hold it for a few years just to break even on the value of it from when you purchased it. So part of the strategy, kind of like when I purchased my building, is basically you borrow money, and over time you pay off that money. So in this example, I used, I think, if you bought a $300,000 building and you borrowed $240,000 or 80% of it, most commercial mortgages are going to be 20 years. If it's a residential home, they'll probably go 30 years. With commercial, it tends to be a five-year balloon payment, and the interest rate gets reset, but a 20-year amortization period. So you can pay it off over 20 years, maybe it's 30. And each year you're going to owe less on it. So if you've got a tenant who is covering your principal and interest payment and all your other expenses, they're essentially making this payment for you. So each year that you hold it, the amount of money that you owe is going down, while at the same time, hopefully, on average, the property value is going up. So here we've got about, I think it's 3% annual appreciation over a 20-year period, and you'd see that $300,000 building go up to between $500,000 and $600,000 in value. So essentially, if you put $60,000 down when you purchased it, held it for 20 years, in this example, it's going to be worth $600,000 at the end of 20 years, and your tenants have paid off all the interest and note on it. So you can really get some good returns using leverage. Whether somebody wanted to do residential or commercial, I think is a personal preference. It's oops, I don't know how that jumped back there. most people, I think, when they're first thinking about investing, are more comfortable with what they know, and people tend to buy a home for themselves and know single-family homes the best. So a lot of people say, I want to invest in real estate. I just want to buy like a single-family home that's a rental house, and then I'm going to rent that out because I know what to do if something went wrong. I think there's a lot of people that do that, and I think because of that, you've got more competition and people are willing to accept lower returns on their investment. So I know one of the first things I did, actually, I bought a single family home and after the building, second investment, I guess, and rented that out, and it pretty much broke even at the end of every year. My tenants paid my interest expense and my other expenses. I spent about a week worth of work per year between finding a tenant, painting between tenants, and fixing things occasionally when they needed it. But really, there was not a lot of income each year, and I think what you'll find is a lot of people who purchase properties are maybe comfortable getting, 3, 4, 5% return on that because they know when they go to sell it, they'll have an asset that's appreciated and worth more. I mean, if you look at what home prices have done in Traverse City lately, they're going through the roof. So just holding a property for a long time, you can get good appreciation on it. And I think residential tends to appreciate maybe a little faster than commercial. Commercial buildings depreciate in terms of if you take like a medical office building and it's built today, 20 years from now, chances are the next tenant who moves in there, the next buyer who buys that building is going to want more modern things in there, more things updated, and it's going to need some money put into it to really, bring it up to its luster again. So you might not get as much appreciation with a commercial building over the long term, from the amount it's appreciated in price. You will get a higher return while you own it. So most commercial properties, an office building, industrial, retail building, you're probably going to get at least 7% annually and maybe up to 10 or 11, 12% return each year. So I sold that house because I had a few tenants that were driving me a little crazy. It was too much, something's broken, you need to come over right now and fix it. We can't go to sleep with this like this, and you'd have to run over and do it. And I bought an office building that had a lot of small tenants in there, so even if one left, I wouldn't worry about it. But I found right away with the office building, if something broke, they would kind of call and say, hey, I just want to let you know this is broken, or maybe it's been broken for a couple days and nobody else told me. It might be a broken handle on the toilet or something, but there was 3 toilets, so everyone just used the other one. So there was less urgency to get things repaired. I think it's still really important to maintain the property and keep it in good repair and keep your tenants happy. But I was a lot happier without kind of everything being an emergency. If the heat went out, there were multiple heating units, so it didn't get colder than 62, and if the heating company couldn't get there till the next day, nobody was yelling at me that their kids were freezing or anything like that. So those were some of the advantages to commercial, and why I like commercial better than residential. But I think everybody has to find what their comfort level is and what you like doing and kind of what returns are acceptable to you and when you get that return. So how do we evaluate different properties? If you're looking at residential or commercial and you say, all right, I'm thinking about this or this, I don't know which to buy. There's a number of different valuation tools that you can use to determine what's a good investment. And most of them, generally, what you want to figure out is, okay, what is my net income? How much am I going to make after all the expenses on this property? So you take your income, you subtract your expenses out, and you come to your net income, which is actually your cash in your pocket. And a lot of the expenses are fairly obvious. You're going to have repairs in the building, utility bills, snow and lawn maintenance. A lot of times with commercial buildings, the tenant pays for all of those, or maybe repairs are split. Property insurance, you're going to have to pay a management fee, or if you're managing yourself, make sure you're getting a little something for your time. It does take time. Your time's valuable, so there should be some benefit to you for taking care of the property. But a couple of the expenses that are maybe a little less obvious would be vacancy rate. So if you buy a building and it's full, or you buy a house and it's got a tenant in it, chances are at the end of their lease you're going to have a couple weeks with no tenant before the new tenant moves in. Maybe if it's a long 10-year lease with a national tenant, or 20-year lease with 30 years with CVS, you don't have to worry about it that much. But most buildings, you are going to have vacancy between tenants. So I usually take a percentage of the income and say, all right, this is an expense that I'm going to have overall. Maybe it's 5% every year on average of vacancy. Another expense is commissions. If you're going to need somebody professional to help you lease that when the tenant leaves to get a new tenant, you might have commissions that you need to pay on that. If you're doing it yourself, you might have to pay for advertising. A lot of times, single family is nice. You can put an ad in Craigslist and find your tenant, or a sign in the yard. So you might not have that, but it's important to think about. And then the last one is taxes. And I highlight taxes separately because it's such a big problem throughout Michigan, where somebody buys a property and they say, what are the taxes? And whoever they talk to tells them what the current taxes are, whether it's a real estate agent or the current owner. And the following year after they've purchased it, taxes are uncapped, and they've got a new tax bill based on generally their sale price. So taxes might be way higher next year than what the current owner's paying. So it's important to really find out, okay, what are all my expenses going to be, and then come out to figure out, all right, what's the net income that I get on this property. So then once you've got the net income, there's a number of different valuations tools that you can use. First one's called cap rate, which is really just a snapshot of kind of 1 year of income. It's just a really quick tool to use to compare one property to another. So if I purchase a property for $300,000 and I've got $30,000 of income coming in from the tenants after all of my expenses are paid, I'm going to be getting 10% on that property, or a 10% cap rate or capitalization rate. Now that assumes that I'm purchasing it with all cash. So I put down $300,000 in cash, and I'm getting $30,000 income, so I've got a 10% cap rate. I've had other investors that said to me, like, I don't care about anything but cash flow. Just tell me how much money I'm getting at the end of the year. That's all that matters. So in that case, you've got to deduct your mortgage payments from your net income, because that's not an expense that you normally include. That's variable depending on how much you borrow. So in the $240,000 borrowing, at 5% interest over 20 years, your payments are going to be about $19,000 a year. So in this example, your cash flow is $11,000. So if you put down $60,000 on this investment because you borrowed 80% of it, you're getting $11,000 every year for that investment. And then you can also use that to come up with a percentage rate, so cash on cash. So the cap rate says I'm putting down $300,000 cash and I'm getting a 10% return. The cash on cash says I put down $60,000 because I leveraged it and borrowed money, and I've got $11,000 a year I'm getting in income from that, which comes out to an 18% cash on cash return. So you can see how leverage increases your returns and really kind of boosts the potential income that you can make on it. And then the last one I want to talk about is called internal rate of return. And there's a lot of different valuation methods. This is just kind of meant as a quick overview. IRR looks at taking those annual returns, what you get each year, but also adding on to it the fact that you're going to sell the building at some point, and at whatever point in time you sell it, it will have appreciated in value, and you've got a return based on that too. So some of the calculations can get very complicated. I could spend an hour easily on this. This is from the CCIM class that I was talking about, and it's a great tool. We spent a whole week kind of learning this and going over it. But basically, you can see you've got it's a 10-year model, and you start with about $11,000 a year in year one, and each year that's going to increase because your rent is increasing each year. And you can change assumptions to figure it out however you want. But you've also got a value of the building that starts at $300,000. It's on the bottom line here and goes up about 2% a year to $360,000 at the end of the 10-year period when you sell it. And if you look at your $60,000 investment and all the payments that you get over 10 years and the money that you get when you sell it, in this example, it comes out to 26.9% return on that $60,000 investment. So you're really, this would be a great investment. And then there's an after-tax return too that factors in tax rate, and there's some tax advantages to real estate that I'll go into in a little bit as well. And I wanted to say all of these slides are going to be on the Front Street Foundation website. So if you want to look at this in more detail, it'll be on there, and you can take a look at it. So tax advantages. There's your basic tax advantages. One of them is you can write off all of your business expenses. So if you need to repair the property, you can write that off. If you need to, your insurance, taxes, those are all write-offs. Interest, if you've got a mortgage on it, all those interest payments are deductible from your income. But one of the biggest advantages to real estate versus like a typical business is that you've got a depreciation deduction. So what depreciation is basically the IRS says, okay, you've got a building, generally we think it's going to last for 39 years, and over 39 years you'll have to replace everything. So you can deduct the value of that building over a 39-year period. With a residential house, it's a shorter period. I guess they're not built as well. 27 and a half years, you can deduct the full value of it. So that depreciation only applies to the building or the house. It doesn't apply to the land. So if you bought a $300,000 piece of property and say the land is worth 10% of it or $30,000, you could take the $270,000 that's left and depreciate that over either 27 and a half years or 39 years. And on the 39 years comes out to about $6,900 per year that you can expense and take that off of your net income each year. If it was residential, you'd be at about closer to $10,000, so that's an advantage to residential. You can depreciate it a little faster. But that's going to reduce your net income, which effectively lowers your tax rate. So if you're in a higher tax bracket, by writing off that depreciation, you're going to pay less taxes than you would if it was ordinary income on another piece of property. Whoops. And then another tax benefit is if you do depreciate it, well, you have to depreciate it. At the end of, when you're ready to sell the property, you would actually have to pay tax on that, recapture tax on the property that you've depreciated, as well as any gain on the property. So we all hate taxes, and if you sell a stock, you pay tax that year. There's pretty much no way of getting around it if it's appreciated, except to offset it with the sale of something that's lost money. In real estate, you've got what's called a tax-deferred exchange, which is an option, which is a section of the Internal Revenue Code. It's called 1031. Sometimes you'll hear it referred to as a Section 1031 exchange. And it's a part of the code that says you can make a like-kind exchange. So if you sell investment real estate, you can purchase another piece of investment real estate and defer the taxes and not have to pay them until you sell the new replacement property. This slide's a little complicated. Again, you can kind of read through it. It goes into the mechanics of it and the details of how it actually works. You can't actually sell it and take the proceeds. You have to set up a qualified intermediary to hold the funds for you after you sell the purchase or sell the building. And then you've got 45 days to identify a replacement property and 180 days to close on that property. The intermediary uses those funds to close on the new property. And there's a number of rules on that are important to check into to make sure that your transaction qualifies. Otherwise, the IRS will say, no, you do owe the taxes. So if you're planning to do it, you need to set it up right with a good intermediary. But what it does is allows you to sell a building. Maybe you've had it for maybe you've had it 39 years and depreciated the whole thing and want something else. Or maybe you've just had it 5 and somebody offers you a great deal and you want to sell, but you don't want to pay the tax. Or there's another property you like better that you want to buy. So you can buy that replacement property, and you can do this as many times as you want and keep deferring the gain. I would say that, I don't know if it's a strategy or a goal, but for a lot of people, accumulating wealth, the goal is to pass it on to your heirs or your children. And I would say the goal is to die without having paid the tax on it. And then when it's inherited at a stepped-up basis, so then that your children could sell it and they would not be responsible for the appreciated taxes on it. So I don't know if death is a good strategy, but could be good for your long-term family wealth, I guess. It'd be too far away. Another thing on real estate in general, I think it's really important to know the market and know what you're planning to buy. Real estate is local. It varies. I think the red dot is probably bigger than the area I know, but that's about all I know of real estate. So kind of know the market that you're in. Find out as much as you can about what typical rents are, typical properties are selling for per square foot. And if you don't know the market, find someone who does. So there's a number of people in this room tonight I see who certainly know the market and are familiar with it, but finding a trusted advisor, a financial advisor who can help answer some of those questions for you. And then really, in order to find a good investment, there's a number of different analyses you can do. Spotting trends in the market is a really good way to figure out, okay, what's going to be the next hot property, what's going to go up in value, or what's going to be desired by potential tenants. I've got some tenants, and what are they looking for? So demographics is a good way to do that. If you know your population, if you're in an area where there's a lot of baby boomers or people retiring, you might look for assisted living facilities. If there's a lot of young people, you might look for, open offices. Office space has kind of changed over the years from individual offices, and now people want an open office with a collaborative area. So if you buy a building, it might be something that you could renovate and turn into that, or maybe it already is that. But kind of getting ahead of the trends, thinking, what's going to be popular over the next 5 or 10 years. How can I fix up this building to make it, or house, to make it what people are looking for today, and what's it going to cost to do that? And then there's also quite a few risks. So I guess knowing what risks and what could be pitfalls is going to be a big help to making that investment too. So first one I've got in here is interest rates. If you've got rising interest rates, chances are values of real estate are going to go down. People aren't going to be able to afford to pay as much for their home if when they're financing it, their payment's a lot larger. With borrowing money for commercial property, same thing. You're going to that lease payment's not going to cover as much. So rising interest rates can make values go down. If I'm getting 8% on a piece of real estate, and now all of a sudden I can buy a bond that pays 8%, well, guess what? That's a lot less work. I might as well buy the bond and not have to worry about my tenants moving in and out. So now, when bonds are 8%, I'm going to want 12% of my real estate. That does tend to put downward pressure on pricing, but there's also something to be said that real estate is slightly hedged in that when interest rates go up, lease rates also go up. So there is the possibility to have higher income coming in to offset that, but that is something you have to evaluate. Also, your tenant. What if they go out of business? What if they close? If I'm looking at a piece of real estate and I'm buying it because there's a tenant paying a really high rent and it's got great cash flow, and that tenant goes out of business, we've certainly seen a number of big retailers go file for bankruptcy in the last few years. Am I going to be able to replace the tenant? Can I get somebody else in there paying the same rent, or is it going to be a much lower rent? Or is it going to cost me a lot of money to renovate the building to get that rent again? So kind of evaluating where the rents are, what the risk is. If they're paying a much higher than market rent, it might be worth buying it, but maybe you want a higher return than if they were paying a below market rent. If I've got that's my favorite investment is where you can get a good return with a below market rent, and then maybe if the tenant leaves, all of a sudden you're getting more money. So that's a good problem if the tenant leaves. And then also just thinking about selling the property when you need to sell it. It can take time. I think our average sale time in this market is about a year for commercial property. It's probably gone down in the last couple of years to 9 months, but that's an average. You might have a piece of real estate that you're trying to sell for years, and if it's something that you might need the money out of, you have to be careful that it's something that you can sell, or that you have another asset you can sell if real estate takes a while to sell. There's risks when you're purchasing too that you'll want to go through good inspections. I mean, really checking out the property, making sure there's no hidden surprises. You don't want to find mold in your basement or attic that needs a big remediation or is a health risk for your tenants. Environmental concerns, I deal with that a lot on commercial properties because it seems like everything in Traverse City was built on a former gas station. But a lot of times it can be mitigated if you know what's there. It might not be a risk or be a problem, but you do really need to go through environmental audits. It's called a phase 1 environmental. A lot of times we'll tell you if there is any reason to worry about contamination on the site, and if there is, you might do testing and get a baseline, and you can be protected from any contamination that somebody else did before you by doing what's called a due care plan and filing a report with the state that says there's contamination on the site, but we didn't cause it, it was here already, and here's how we're not making it any worse, and as long as you're not making it any worse, you're covered. So if you don't do that, and say you used, it was an old gas station and you're using gas to fill your lawnmowers and it's spilling all over the grass, well, it might not be that much that you spill, but you could be responsible for a whole lot more gas on the ground that somebody thought was your responsibility. So doing good due diligence, making sure you know what you're buying, and then really maintaining that property. I think I guess there's a few slumlords out there who have made money not doing anything to their house and just renting it for whatever they could. I would bet you could make twice as much money by maintaining it and having good tenants in there and less turnover. So really maintaining your properties, treating your tenants well, making sure they're happy. I think that all helps mitigate risks too. And financing, again, it's kind of whether interest rates are going up or down, whether you can refinance at the same rate that you had before, looking into your financing and making sure that that's positive for you. So kind of concluding here, I'd look for some charts kind of showing real estate appreciation versus the stock market. And this is one I found that I like because you kind of see a lot of charts like this. They took the home price index from 1987 for 30 years and show that homes have gone up I think it's about 3% on this, while stocks are going up 8 or 9%. And I think that's probably pretty accurate on average, and you see a lot of that. What it doesn't factor into account is that over those 30 years, if it's not your primary residence and you're leasing it out, you were also getting rent payments. So if you're earning 3% appreciation over 30 years, but you're also getting somewhere between 4 and 10% on a annual basis, then those compounded returns really kind of skyrocket. And if you take that and you add leverage into that, which is what this chart showed, those three factors can really boost returns. So kind of in concluding, my summary is I think you can get fantastic returns with a real estate investment, but probably the best returns you could get in any investment, but it's more work. It's probably a little bit riskier, and there's a lot of factors that you have to look into. So when done right, I'm a big advocate. And I think that's about it. I'll let Jason come up for a few minutes. Thanks for letting me talk, and then
Well, thank
I'll
you
be
very
around
much.
for questions.
This is wonderful.
Sure.
Thanks a lot. I appreciate it. So we are going to, before we move into Q&A, I want to, again, thank, I got to push my slides here. I want to thank the partners here, the Traverse Area District Library, the Senior Center, as well as Up North TV. Without them, this content would really not spread to the degree that it really does. So it's fantastic.